Good afternoon, everyone. My name is Jake Gronowski. I'm the founder and principal of 12 South Advisory. As you may know, we're a fractional CFO and tax advisory firm here in Nashville, Tennessee, serving clients nationwide. Here in the US, we're doing our weekly Facebook Live today, covering tax benefits of employing your kids within your small business. So thanks for tuning in today. I know the weather here in Nashville, we're supposed to get some snow overnight, as well as some freezing rain and ice. So I hope everyone's taking the proper precautions out there and stocking up on food, and you've got your snow shovel ready. So, so yeah, the tax benefits of employing your kids within your small business. It's a kind of one of the many tax loopholes out there that many business owners may or may not be familiar with. Certain business structures, um, this is able to work with in a, in a better way, I guess you could call it. Sole proprietorships, single member LLCs, and partnerships are kind of the best case scenarios. When one of these business structures, you're not going to be paying FICA or FUTA tax, federal income tax, as well as unemployment. So you'd be saving in that regard. S corps and C corps, the benefits become more limited when you're one of these two business structures. There's not going to be that payroll tax deduction, but you're still going to be eligible to for the wage deduction. Moving on. So the business tax deduction, the wages that you pay your kids are fully tax deductible. Keep in mind this tax loophole, as you could call it. It's explicitly stated by the tax revenue code or tax code, excuse me. So this is not like a kind of just a hush hush thing, hush hush scenario. There's materials published on this, and this is why we're covering it for everyone's knowledge, of course. So your kids are going to be taxed at a much lower rate since they're obviously younger. And we're talking kids, we're talking kind of teenagers, kids that are kind of just, you know, attending school and whatnot. Um, so yeah, income that was yours is now your kids. So you'd be saving in for example, if you were in one of the higher tax brackets, 35 to 40% tax savings in many cases. The standard deduction for 2025 is 15,750, meaning the child that you employ would get to earn up to that threshold until any sort of tax kicks in. So anything that they earn below 15,750 is going to be not going to be taxed. So that's kind of cool there. In summary, instead of paying higher taxed money to the IRS, it could be the opportunity to pay lower tax dollars for your child and actually your child would get paid, of course, and you'd actually receive work in return. And then as we spoke about just a minute ago, the tax code explicitly allows this. So moving on here, beginning to build financial freedom. So as you may know, we've got IRAs out there. A Roth IRA, for example, it's a investment vehicle, investment vehicle in which you pay the taxes up front, and then the money sits in that investment vehicle, and then you're able to remove the funds when you retire after, I think it's 59 and a half. So when you remove those funds, you're not going to have to pay taxes on those. But on the flip side, if you're investing in a traditional IRA, you put the money in pre-tax and then you'd pay the taxes when you take the money out for a distribution at retirement time. So it just depends on where you are within your career. if you're earlier in your career and making less money and you kind of have a higher ceiling, I'd probably suggest the traditional, or excuse me, the Roth IRA, because you'd be paying the taxes now on it while you're in a lower tax bracket. Whereas if you chose traditional, you'd have to pay the taxes down the road, which um, I guess if you're, early in your career now, and then you're kind of going to advance within your career, I'd suggest, going with the Roth IRA. So, so yeah, contributions to the Roth IRA um, can come from the parents, and the child is eligible to start a Roth IRA once they have any type of earned income. And then up to the earned income, the Roth IRA maximum is $7,000 per year for the year 2025, and it's going up to 7,500 for the year 2026, which is the year we're currently in, obviously. Keep in mind there are certain loopholes to that, as well as income thresholds, such as like a backdoor IRA or things like that that we could discuss on a different Facebook Live. But um, so yeah, back to the employing your child. It could be a decade or two of tax-free growth if they did decide to open a IRA for the son or daughter. And as you may know, with compound interest, things can kind of get rolling over, snowball effect in that regard, and the funds could be, six or even seven figures by the time they retire. You know. So moving on, documentation requirements of employing your kids within your business are a well-documented job description, of course, a signed offer letter stating the hourly rate that the child is going to be making. Weekly timesheets are also a good idea to have, as well as approved by the direct manager, signature from that direct manager, and issued W-2 and payroll records. Keep in mind you're going to want to pay the son or daughter to their bank account with their name on it, and then proof of payment, of course, as well. Whether that's a copy of a check or ACH, EFT. It's best to treat the son or daughter as a normal employee, I guess you could call it. It's not in the best interest to cut corners or just because just because they're your son or daughter, you should still, you know, document everything to a T. Record keeping is important within accounting, so you don't get audited by the IRS. Kind of what we just touched on, similar topic, IRS audit triggers, excuse me. Um, so yeah, like we spoke about, if your timesheets and offer letter aren't going to be, you know, approved by a manager or signed off on, that's kind of one of the leading audit triggers that are going to prompt the IRS to want to investigate further, as well as paying a higher than current market rate. For example, if you're employing your 13-year-old son to help with social media or any type of admin work like that, $100 an hour is kind of outrageous for that. So kind of just do your research and see what, depending on what type of work you're employing them for, kind of just do your research and see what the going rate is for that particular job um, job duty. Examples of typical jobs to employ your kids could be, anything administrative to cleaning, janitorial, marketing, social media, stuff like that. And then claiming payroll tax deductions for an S Corp or C Corp, kind of what we touched about on the first slide. Um, this particular rule of employing your kids to save on taxes, it's going to be more related to, your sole proprietorships, single member LLCs, excuse me. So you're going to want to, if you're an S corp or C corp, you're not going to get the same tax deductions as well. So just be aware of that. Pay must be standard W-2 wages, so no 1099 wages, and the job must be appropriate for their age. So I've got an example here. Josh owns ABC Printing LLC out of Austin, Texas. It's a single member LLC. So Josh's marginal tax rate is 32%. Josh has a 15-year-old son named Tate. Josh was looking to take out $10,000 out of the business to pay for Tate's hockey. So before he chose to use this tax rule that we're going over of employing your kids, he wasn't getting any help from Tate, first of all, and then Josh was paying, if he removed this money, he'd pay 32% in taxes on the $10,000. So, and then he'd also pay self-employment tax at 15.3%, as you can see. So total tax paid would be almost $5,000 on that $10,000 distribution, and the net cash collected would be just over $5,200, which so yeah, obviously a lot of taxes there. We all want to keep money in our pocket, so what Josh could do was employ Tate. So Josh hired Tate, as you can see. He hired his son to do some general admin and social media duties, janitorial, and shovel snow. He paid him $15 an hour, and he had, his hourly or his hour, his the pages that you keep track of the hours on weekly. Those were signed off on, obviously, by someone else other than Josh. So Tate worked 667 hours during the year, or 10 to 12 hours per week average. Tate's total wages were just over $10,000. So because of Tate's employment within ABC Printing, Josh would save over $3,200 in wages and tax, excuse me, on those wages, as well as the standard 15.3% self-employment tax. So the net cash to the family would be $10,000. They use the $10,000 for Tate's hockey expenses. So the IRS generally allows you to use, they've got these buckets, descriptions of what you could use the underage wages for, clothing, sporting activities, savings, or future education. So as long as Tate wasn't spending the money on things like drugs or anything like that, you'll be in the clear. So a recap, of course, could be a win-win situation, could be a win for the company owner, Josh, as well as Tate, the young child of Josh's. It could reduce the taxable income of the business, so they wouldn't have to pay quite as much tax. It's going to build wealth for Tate from a young age onward, as well as eliminate certain payroll taxes. Obviously it teaches kids good work habits and a sense of responsibility. So yeah, that's all we have for today. Thanks for joining. My name's Jake Gronowski. Feel free to follow us on Facebook, Jake Gronowski CPA, as well as Instagram, 12 South CPA. I've got my LinkedIn here as well. Feel free to reach out and book your discovery call today. So happy Friday. Wish everyone a great weekend, and we'll see you next week. Thanks for tuning in.